There's a dividend ETF that I bought around $50,000 of, and I would consider it a buy and hold forever position inside my long-term dividend growth portfolio. Now, this dividend ETF isn't the flashiest or the most popular ETF across the entire market, but this ETF does offer consistent monthly dividend income with a rock-solid strategy and an ETF that has consistently went up in price over time. Now, in this video, we're going to dig deep into this ETF, and I promise you are going to want to stick around to learn more about it. Now, if you consider yourself a dividend investor, make sure to drop a like down below and let's get right into it. I just finished my brand new dividend investing ebook where I share exactly how I went from zero to now over 7 figures invested, and also on how I earned more than $6,000 per month in dividends. I also finished my custom dividend tracker that you can use to track your dividend income progress on an ongoing basis. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the dividend focused ETF that I'm talking about is none other than Amplify ETF's DIVO, or the Amplify Enhanced Dividend Income ETF. So heading over to the website, it says why invest in DIVO? Income potential, comprised of high quality dividend oriented stocks, along with covered calls on individual stocks. An active management plan allows the portfolio manager, the CWP, to identify opportunities and risks and act on those decisions in real time. So with this fund being actively managed, you are going to pay a little bit higher expense ratio of just 0.55%, which in my opinion is definitely worth the price. Also, DIVO seeks to lower volatility. Dividend and option income may provide lower share price volatility versus the overall market during times of broad-based market declines. So in a situation where the entire market might be selling off like crazy, DIVO, for example, most of the time is going to have a much less movement, much less beta, which is perfect for more of a conservative income-focused investor like myself. Now, looking a little bit deeper into the DIVO selection methodology, it says dividend growers. DIVO is managed with a strong emphasis on owning high-quality large-cap companies with not only historical dividends, but also earnings growth. Sector allocation, DIVO is relatively balanced among the traditional 10 S&P sectors, with CWP determining which sectors to over and underweight based on various factors, which of course can be changed over time. Also, security selection. DIVO consists of 20 to 25 stocks, which are screened and adjusted accordingly according to attributes including market cap, management track record, earnings, cash flow, and lastly, maybe my favorite aspect of this entire fund, covered call options are written on individual stocks on a tactical basis, not an index approach. For those that might not be aware of it, covered calls involve buying shares of a stock and then writing call option contracts on some of those shares. A covered call could also be referred to as call writing or writing a call option on a security. And for beginners out there, it's going to be a little bit confusing because there are different terminology and different ways to say the same thing. For example, if you want to sell a covered call, you could also say that I'm looking to sell an option. There's many different ways to say it, but they all pretty much mean the same thing. So other investors can then purchase the call option that the sellers are of course selling to them. Now for the contract buyers, they pay a small fee to the call writer, known as the premium for doing so. Now the contract gives the buyer of the option the right, but not the obligation to buy shares at a specific price on or before a specified date. In the case of call options, when the share price of the underlying security rises above the strike price that is agreed upon, an option holder can choose to exercise the option, at which point the stock could be called away from the person who wrote the call option or that sold the call option. Now the whole point of this is then the option holder then receives shares at a cost lower than the current market value, and that's sort of the value of buying call options. Their profits will equal the difference between the option strike price of what they agreed upon and where the stock is currently trading minus the premium paid. The higher the stock price rises before the expiration date, the greater the profit for the person holding the call option could be. Because the call option writer receives the income on the deal in the form of a premium, they want the stock price to either stay flat or fall or slightly rise in order to basically keep their shares, but also, of course, make some massive profit off the premium. So a lot of the covered call ETFs out there, they buy into an index and they write a covered call on the index, which is sort of an easier, less management intensive way to do things. But DIVO writes calls on individual stocks, which I absolutely love. So now that we talked a little bit about what DIVO is and how this ETF works, let's talk a little bit about its performance long term. The ETF is up around 50% as far as price return goes, and that's not all that bad considering this ETF is relatively higher yield and it's only been around for say 8 or so years. Now, as far as this ETF dividend goes, this is one of the main reasons on why I really like this ETF as a dividend-focused investor that's probably going to be using some of my dividend income within the next, say, 3 to 5 years to cover things like bills and, of course, have some money for travel. This ETF does offer a relatively speaking higher dividend yield from day one, at around a 4.57 trillion 12-month dividend yield. Now, like I also mentioned, Divo does pay a dividend monthly, so that is going to be helpful for those that are looking to use some of their assets like this one to retire, because of course bills arrive on a monthly basis, generally speaking. Now, because of Divo's overall strategy, it's not necessarily going to have that much dividend growth, and I'm not really expecting it to long term. But that being said, if Divo consistently can go up, say 4, 5, 6% per year as far as ETF price, and offer a starting yield of around 4 or 5%, depending on where you buy Divo at. For a relatively risk-averse investor like myself, I think Divo is a perfect addition for a long-term portfolio. Now, I did mention that I purchased around $50,000 worth of Divo ETF, and this is where we're sitting at currently throughout my portfolio. I currently have around 1,424 shares of Divo, and this is across all my multiple portfolios, with an average cost of around $34.88 per share. So I think if you add that all up, it gives us right around $50,000 that I spent so far in the Divo ETF. Now, although throughout 2024, my main goal was to build out my SCHD position, which is currently at 548 shares, just as of recently, I did sort of decide that I do want to add a little bit more of my cash balance on a weekly basis to Divo, just because I am looking to get this portfolio to generate a little bit more income a little bit quicker. Now, with that being said, I'm of course going to keep buying my daily purchases more or less of SCHD, and I really want to get my SCHD position to 1,000 shares by the end of this year, and I'm willing to do pretty much whatever it takes to get there. Now, with my Divo shares sitting at around 1,420 some shares as of right now, I think I am going to make a new goal to maybe try to get this position by the end of the year also up to say 1,700 shares altogether, or even maybe closer to 2,000 shares, but we're gonna have to see what we can do. The last thing I want to go through when it comes to the Divo ETF is this page right from their investor guide. From their website, it says the advantages of income producing equity investments. Demand for these companies extend well beyond risk and return. Here are some additional reasons why investors continue to seek out dividend-paying companies, along with investment that generate income from conservative strategy of writing call options on positions already held in the portfolio. So with this, we have predictable income. There are thousands of companies that pay monthly or quarterly dividends and may have a track record going back decades. Not every dividend payer is worth owning though, of course, but the sheer number shows that the desire for income is ongoing and has definitely been growing in the past, it seems. It also says protection against inflation. Fixed income products expose investors to interest rate risk. Fixed payments lose purchasing power in inflationary environments, but companies can increase dividends, and based on an average of all rolling 12-month periods since 1940, dividend growth has exceeded inflation by an average of 2.4% per year. So obviously it's very hard to beat inflation, but invest into certain high quality dividend payers that have a history of dividend growth can definitely help fight against it. Now, also drives total return. According to the S&P Global, dividends have been responsible for 32% of the total return of the S&P 500 index since 1926. Adding a conservative covered call rating strategy overlay has helped the potential to help drive total return. And lastly, when it comes to dividends, let's talk a little bit about the tax treatment. Dividends paid by U.S. corporations or qualifying foreign equities are taxable to investors at rates ranging from, of course, 0 to 20%, rather than the investor's marginal rate, depending on taxable income. And with Divo specifically, we might want to go over this all in a different video. Comment down below if you guys want me to go through this. But the way that most of Divo's dividends are taxed are very favorable for investors like myself, and likely even for you. Now, the last thing I want to touch on, and maybe this is sort of obvious for some of you guys watching this, but I just want to make it clear that for those investors out there that aren't necessarily all that concerned about dividend income from day one and want to have a larger total return long term, meaning that they want more exposure to some faster growth, even if it means they're going to get paid a much lower dividend consistently. Now, in that case, if you identify as that kind of investor, the Amplify Enhanced Dividend Income ETF probably isn't the #1 pick for you. But for those investors like myself that want to have slow and steady consistent growth, but also want to get paid a little bit more in cash flow starting day one, the Divo ETF is an awesome ETF that I definitely think every single one of you should look into. So now that we went over what one of my favorite income generating ETFs is across the entire market, and we went over everything this ETF has to offer, I want to lastly hear from you guys down below when it comes to Divo. Are you currently holding any shares of Divo across your portfolios? And if so, how many shares do you have as of right now? If you enjoyed this video, make sure to please drop a like and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.